Hey, thanks so much, guys, for coming out to DAS NYC Day 3. I know it's been a slog this week, but Carlos, John, glad I could have you guys here on the final day to talk about tokenization. Um, being at Ava Labs and Securitize, I'd love maybe if you guys could just kick it off and just give a quick background, what you guys have been doing in the past and why tokenization now, why this is such a big thing and why you're leaning in.
So Carlos and I have known each other and been friends for far longer than just Ava Labs. We're talking about 8, 9 years back. My background, I was a traditional finance hedge fund slash VC investor in technology companies. And then in about 2017 or 18, I noticed this crowdfunding called ICO thing that was happening. And I thought that's a better way to do capital formation. And I became CEO of the digital assets group at Shares Post, trying to tokenize private securities. Killed probably too many brain cells trying to get the SEC's permission for a no action letter on an ATS and convert it to use it for that. Carlos was there with me at Securitize trying to solve the same type of problem. So we've had the same vision. The short story is I realized we were way too early and there were three things to solve. One was the regulatory wrapper. Another thing was socialization of it. Institutions were just not ready. And the third thing was the technology wasn't really ready. I mean, Ethereum, CryptoKitties, and gas fee spiked and things broke down. So I realized no human being can try to solve all three problems at the same time. So I, luckily, through my undergrad and innovative technology professor and founder of Avalanche called Dr. Eamon Gunseer, was already trying to solve the tech problem. And I became president of Ava Labs Avalanche to focus on just that while I let Carlos figure out the reg tech problem and probably kill more brain cells than I had to.
And I killed a lot of brain cells solving the RegTech problem. So I started the company in November 2017, but I was in this tokenization space since 2016. Did one of the early tokenized funds before founding Securitize. That's when John and I met, as he mentioned. He actually did mention that we actually did the first actual trade of a tokenized security on chain with an ATS that he had at SharesPost and the tokenization technology that we had at that time. And he got a no action letter from the SEC, etc. So those were like really, really early days. So as I mentioned, we launched the company in January 2018 after being created a couple of months before. For many years, nothing happened in the space. It was very slow adoption. Crypto was going in completely opposite directions, whether it was NFTs or DeFi or other things. And I think because of also the Gensler years, there was a bit of an allergy to anything that was regulated because there was a lot of concern about the SEC, and the SEC was very aggressive with everybody, including with people like us, always not arguing whether what we do is under the SEC and securities. Clearly, security is what we do. But then, look, a couple of things happened the last couple of years. I think the first one is the launch of the build fund with BlackRock. I think the largest asset manager in the world entering the space was a massive signal to everybody that this was something to take seriously. Not only they entered the space, but they did it in a very successful way, obviously with a very good company like us. But their fund became the fastest growing and the largest asset in the industry very quickly. And I think more recently, the other big thing that has happened is the regulatory shift with Chair Atkins taking over the SEC, being super bullish with tokenization, and now being definitely what every single asset manager, bank, or exchange is looking at figuring out how to participate in this industry, which could be super disruptive to some of their existing business models.
Maybe you guys can speak to, you clearly mentioned a concerted approach to sort of attack this problem from different angles. I'm wondering if, leaning in on sort of the on-chain side versus, the efforts over at Securitize, if those experiences have, lend to your viewpoint on the proper approach in getting the right product to kind of like to the market and also approaching the regulators in the right way.
So I think you're hinting at the permissionless open world versus more of this closed way. And I mean, it's fair to say that, when I first came into blockchain, it was about crypto assets, and now it's about enterprise technology. And, I think in a weird way, it is great that adoption is happening, but also at the same time, it's kind of bittersweet because the people that are adopting it now are the people who we were trying to disintermediate. and the benefits are going to accrue to the existing large players. So it's a little bit of a bittersweet scenario, but I do think that there will always be two worlds and parallel paths for the permissionless and the permissioned.
My view is that we're mixing the concept. So the fact that the infrastructure is permissionless, it doesn't prevent that the asset is permission, right? Because the asset at the end of the day in the tokenized space, it does represent a security, right? And securities are regulated and they're transacted by regulated intermediaries that have KYC obligations, that have AML obligations, etc. So it's very hard to think that you can issue a security in a completely permissionless way, because that's going to break a million different rules in pretty much every single jurisdiction. That doesn't mean that people are not doing it, because obviously this is crypto. You're always going to have people breaking the rules or doing regulatory arbitrage from some bizarre offshore jurisdictions and blocking the US, thinking that that solves the problem. But the reality is that that shouldn't be a problem. Like, people are a bit obsessed about the fact that, tokenized assets need KYC. But look, I do remember when I started in the space in 2016, you could open an account with Binance with email and password. You didn't have to do KYC. And then when the regulators started getting concerned about money laundering, and they forced every single centralized exchange to have KYC, which today every single centralized exchange has KYC, the crypto people say nobody will trade crypto because you have to do KYC. Guess what? People traded more crypto because you have KYC, because it became a safer asset class, more institutions came, more money put into the space, etc. So this obsession with trying to make everything permissionless at the asset level, thinking that if not, people are not going to adopt it, I think that is not true. And look, equities trade in broker-dealers that are all obviously KYC, and there's hundreds of millions of users trading equities every day and trillions of dollars being traded there. This is fundamentally a better technology to do that, and the fact that you have to KYC the user and whitelist the wallet, etc., shouldn't prevent this industry from growing.
So I think Securitize has done a great job of taking the existing rules and making it work for this space. I think the issue I have with the whole system is that these rules and these frameworks were set up for a world of intermediaries. And the whole purpose of the blockchain is that it's a programmable asset and the rules can be encoded into the asset itself. So that, do you really need, in the end of the day, a DTCC who is set up to actually clear paper trading back and forth to make sure things got moved around from one person to another? That is the blockchain itself. You still may need a transfer agent to have some oversight over the movement of that, and that's what they have from a license perspective. But a lot of the rules were set up for a world that doesn't necessarily have to be today because it was yesterday.
And even so look, when I'm old enough that most of the audience here, so when internet started, people thought the internet, because it's a decentralized infrastructure, was going to eliminate intermediaries. And that didn't really happen. What happened is that the world reorganized around different intermediaries that were cheaper, better, faster, providing more services, etc. So you move from being intermediated by a telecommunications company to be intermediated by Google or Facebook. But obviously Google and Facebook are tech companies. They give better services. They're free because they have a different business model, etc. So people are happier generally now than in the past. So on the blockchain, it's very difficult to think that some intermediaries, like John mentioned, DTCC, in my opinion, disappear because the clearing and settlement is a function that is embedded on the blockchain itself. But some of the intermediaries, like let's say a broker-dealer or a transfer agent, they'll still exist. However, I do believe that because they will be tech-enabled and use blockchain, they will be much more efficient. And just give you one simple example. Today, we process daily dividends for the BlackRock product across 7 different chains for a total of, let's say we pay on an annualized basis around 4% for, over $2 billion in AUM, right? We don't charge BlackRock for it. Why? Because it doesn't cost us any money to do it. We just run a blockchain transaction. We don't have any reconciliation errors because we know in real time who holds what are the balances of tokens in each wallet. We then mint tokens, which are additional units of the fund. The investors are actually making more money because the day after, their holdings have accrued the interest in the forms of more units of the fund, so they're actually earning more interest than if you were paying dividends only once a month, etc. And that's an example that we're still acting as an intermediary to BlackRock, but the service we're providing is much more efficient and cheaper and better than what they had before because of using blockchain and tokenization.
Maybe we can take it another direction here. One of the often talked about, benefits to tokenizing assets is this idea of accessibility, global accessibility, opening up assets to places that previously have had difficulty, maybe getting at, the ability to trade them or use them. I know you guys, Securitize and Avalanche, have had a recent success here in the EU. Your tokenized trading system received some regulatory approval there. Can you talk to me just about, and the audience, about what does that really mean, accessibility by tokenizing products?
Well, I'll start and I'll let Carlos finish. I think we're very happy to be part of that with Securitize. Basically, Securitize has received a similar thing as what an ATS is in the US, and they're going to do all the stuff on top of Avalanche. So we're the tech, they are the regulatory wrapper. Kudos for you for getting that deal done. Ultimately, I think this is great, as most Americans in this room will like it, because stablecoins are 95% dollars. And I'm biased, but it's pretty clear based on market cap, the best companies in the world are American companies. And there's still a lot of friction for someone in Europe to go buy Apple stock or Google or whatever. Ultimately, tokenizing these assets and making them more global, not only will the assets be exchanged in dollars through a stable coin, but it just makes the whole US financial base stronger because everything is in dollars.
So then, look, I'm European, so, but I live in
the one Spaniard that knows more about market structure in the U.S. than anyone I've ever met.
But so people in the U.S. don't realize that in other and Europe is a civilized part of the world with a lot of problems that we don't discuss here, but it's not like an underdeveloped part, right? But there's no culture of trading stocks. That the culture the Americans have here, it just doesn't exist there. So therefore there's less infrastructure to access stocks, and there is less accessibility for some for stocks trading. Like when we announced that we were going public through a SPAC, some of my friends from Europe were like, "Oh, where can we buy the SPAC?" And I was like, "Oh, go to a brokerage house." It's like, "Oh, our brokerage house doesn't list and doesn't offer anything that is listed on Nasdaq." So period. They can just not buy the shares. So I do believe that tokenization can basically abstract out the underlying regulatory friction in each country because it's digital to make tokenized assets, whether they're dollars or US equities, which I agree are the best companies in the world, to make them more accessible. And that doesn't mean that you still don't need a license locally on that jurisdiction to be able to do things like solicitation or trading. So what we are doing at Securitize is we're trying to build a platform that, from the investor perspective, it's just a single platform, has the same products, works the same way, but underneath, depending on which jurisdiction you are, you're being served by a different regulatory license that we've obtained on that jurisdiction. So once we got the full stack of licenses here in the US, we went to Europe and then collected the same stack. And then the first part was to get a broker-dealer approved for tokenized securities. We got one in Spain and then passported out to 24 countries. And the second one was we wanted to be able to settle trades on-chain under a European license. So to do that, the European regulator actually asks you that you actually show the full tech stack that you're going to use to do it. So we had to decide who we're doing this. And of course, we've been partnering with Avalanche since our first tokenized asset with KKR. But just there was two other reasons to do it with them, which are important. One is when you're talking about trading public equities, there is a concept of best price, best execution that you need to provide. And then if the underlying tech stack is not fast enough, you can be front run by the same asset being traded, let's say on Nasdaq or New York Stock Exchange, that are very efficient. They might be centralized, you might not like them, they don't have a blockchain, whatever you say, but they are very efficient. It trades very, very, very fast. So speed is important. And the second thing is that because you're trading regulated instruments, deterministic finality is important. And a lot of blockchains, a lot of people don't realize that some blockchains have probabilistic finality. And in some cases, if you're talking about an L2, it could take like a week till it has settled on the underlying layer, let's say on Ethereum. And then for the regulators, that makes their head explode because, we have reporting obligations. So if we trade in stock, we have to report the trade immediately and record it for the regulators to review in case there's a problem or to examine us in case of there's, I don't know, insider trading or whatever. And if a week after we have to go on and widen a transaction, that's a problem. So being able to settle a trade in a deterministic manner fast, I think is something that a blockchain needs to have to be able to be a good foundation for, capital markets. So, and definitely Avalanche meets the requirements.
I think you started to get into it. Maybe, we sort of talked about where you've come from, where things are today. If we talk about the future, as we close things out here, like the topic of this conversation is tokenization is eating the world. Do you foresee a lot of the conversation within the crypto industry has been around, a replacement of legacy rails with new on-chain rails? Is tokenization a replacement of, the legacy institutions and settlement layers between equity houses and trading firms and brokerage firms, or is it a complement that becomes, an advantage for these partners at some point in the future? What are your views there?
I would hope it becomes a replacement, but it'll be a complement before it becomes a replacement. That's just generally how things do. It's an evolution. It's not going to turn overnight. But what's your opinion?
I don't know. My view is the following. So first, the traditional infrastructure, no matter how inefficient looks like, etc., is not going to disappear overnight. Like I saw that there was you guys were posting some news here that yesterday Chair Atkins said that in 2 years all the stock market will run on blockchain rails. I wish that was true, but I don't think it's going to happen. So I think that's a very, very bullish, optimistic thing. And having been here for years, I know things don't happen overnight that quickly. Large institutions are very conservative, are very protective of their, incumbent situation, etc. So things don't happen that fast. I think that what we're going to see is that you're going to have traditional markets that will stay here, and then parallel markets that will run on blockchain rails that will, start moving in parallel, and that will start with being 1% of the total, and then another day 2%, and then, for a few years after 10%, and then 25%, etc., till that becomes the main markets. But they will coexist, running in parallel, if you want, financial services markets or capital markets for a period of time. The same way that, look, there's things like, mainframes for banks that never disappear, right? Because sometimes, no matter how much more efficient it was to run things on the cloud, it's just like not worth moving the legacy and let it continue sitting there for a while until it kind of like expires. So I think that we're going to see that situation where we're going to have the same way today that you have the crypto markets that are completely separated from the TradFi markets. You will have the same, but for tokenized assets, where you have tokenized equities sitting here and non-tokenized equities sitting here, and they'll be different. So they'll be the same instrument, but they will be trading on the different rails with different market participants, different intermediaries, etc.
I think that's a great framing. Maybe one last question for you then around this idea of, there's a lot of teams and firms competing in this arena now, a bunch of different teams going after tokenization. You hear the sentiment a lot that, every bank will have their own stablecoin. All of these different fintech platforms will have their own varieties and flavors of tokenized assets. What do you think that world looks like? Is it everyone sort of playing in the arena? At some point that compresses and there'll be, a few issuers, a few tokenizers, a few issuers that sort of dominate in the way that we see, ETFs are kind of top heavy and there's like a few sort of key issuers at the top and maybe a variety of things at the fringes. How do you think that evolves?
Do you want me to talk about the technology first, or do you want to go first?
You can go ahead. I have to back.
From a technology perspective, we just care it gets done on Avalanche. All joking aside, I do think it's going to be a multi-chain world, and one of the best parts of Avalanche is the connectivity of it. It's EVM compatible. The L1 subnets can move things around, and if you have to go to Ethereum, it's easy to do that. If you want to, and it's actually, I see 5 or 6 team members here. I think one of the best parts, and you guys have heard this a million times, we think of Avalanche as a place where people want to build because you have control, you have connectivity, and you have the best performance. Carlos talked about deterministic settlement, instant finality. So that's, what we think will lead from a technology perspective until people don't even talk about a blockchain. It's just abstracted away.
So from the perspective of are they going to have many issuers or many tokenization platforms, I think my answer is yes. and let me tell you why. So first, we're the largest tokenization platform. We don't even have like more than 50% market share. We fluctuate 20, 25 depending where our assets are or where the competition assets are, right? And we're the largest one. And I don't think that we will ever have 90% market share like on stable coins, because the stable coins, they're essentially all the same, right? is tokenizing dollars. It's one asset class. When you talk about tokenization, you're talking about hundreds of different asset classes. You're talking about stocks, bonds, you're talking about treasuries, you're talking about CLOs, you're talking about credit, you're talking about all sort of alternative assets, real estate, etc. There's just too many asset classes to think that a single tokenization platform is going to, have 80% market share in all of them. And we see no too many projects that end up going to our competitors, and so be it. We just want to focus on where we think we're gonna do well. And from an issuer perspective, it's the same. Like, I mean, I don't think that the market, maybe in the ETF space especially, you have companies like BlackRock that dominate more than others, but there's quite a lot of, ETF issuers out there, and there's certainly thousands of issuers of stocks because there's thousands of publicly traded companies. There's, thousands of issuers of bonds, and because every company raises debt, and there's tons of different real estate companies. So I think that you're going to have a very fragmented situation. What I hope for is that at least we kind of share a little bit standards in how these things are done, so all the infrastructure is a bit more compatible. We announced this week the partnership with the New York Stock Exchange, which part of the partnership is to help them define standards for tokenization, to make sure they don't end up having to deal with integrating with 20 different tokenization platforms that do it in a completely different way. And by the way, it's not that complicated to agree on those standards. So I think that as far as we kind of all agree on certain interfaces that everybody plays by the same rules, then you're going to have a ton of different issuers and tokenization platforms.
Gotcha. Love the pragmatic view. Well, John, Carlos, I appreciate you for joining me here on the Insights track, and thank you all out there for listening. We appreciate you for tuning in.
Thank you. Thanks for having us.